I'm John Griffiths, the founder of Verus Property Investments. And today what I wanted to talk about was the government mortgage guarantee scheme that they released in their budget that they're doing. Now, as a property investor, I have to say that there's a lot about it that makes me very reminiscent of the crash back in 2008, and the government scheme that they're bringing in is based on the one that they did in 2013, I believe it was. So it was what they did after the crash to stimulate the economy back and to restore confidence and get people back onto the housing ladder. I'm sure there was some politics involved in their reasoning for pursuing that as well. But the issue with these government-backed mortgages is that these people cannot afford property, and all you're doing is fudging the numbers so that they can afford it, when in reality they still can't. And they're going to also be paying a premium rate for these products as well, because it's 5% deposit. Now, what does the government scheme actually entitle the government to actually do? Well, they'll cover down to about 80% of the loan amount if it goes to a repossession. So they don't cover the full amount of the loan, so the lenders are still responsible and liable for a small amount of that. However, it would be fair to say that with the government support on such a large amount of that loan, that the lenders would be able to manage that wave of repossessions if there is a wave, and they won't be in a situation where they need bailing out, let's say. So there's some mitigation that's going quite well for them. But the government has implemented a limit on how much of these mortgages they will actually cover, and that's set at 3.9 billion. Now, the current mortgage market for 2020 is 3.9 billion. Oh, sorry, my apologies. No, not 3.9 billion, 1.5 billion in Q3 of 2020. So it's fair to say that their limit of 4 billion that the government will cover if these individuals do default on their payments seems to be a large amount that more than covers those losses. But you have to ask, how many newcomers will come into the market and will increase the mortgage loan volume of the country? Now, 95% mortgages are perfectly fine if there's no sudden dips in property prices. And I feel like it's important to just mention that throughout 2020 there was a lot of legislation brought in to sort of slow down and put restrictions around possession claims. In fact, possession claims were down by 99% in the final quarter of 2020 compared to the previous quarter. Basically, none of them are actually going through to repossessions. I think the number was 7 repossessions in the final quarter. So when we go back to normal, all of these pending repossession orders will suddenly come to market, and they will be getting processed through the courts, and you'll suddenly see a wave of likely distressed properties come to auction, and lenders are typically going to be selling those properties at a heavy discount normally, because for the lender they just want to recuperate their losses and they want a quick sale, so they're a motivated seller in that regard. So you're having this wave of properties come to market being sold for a heavy discount, which you would expect to have a bit of a ripple out effect to other properties, and that might force the valuations down, and also a indicator of high repossessions and these properties coming to market, being sold for a heavy discount, may be a strong signal that the property market will dip or suffer a bit of a crunch. So even if there's not a dip, the signal alone may lead to that eventuality. Just referring to my notes here, I did some research this morning. Now, if property prices do go down on the back of this wave of repossessions that we're likely to see, and a lot of these properties are likely to be distressed because if they had possession claims for them and they haven't been carried out in basically the space of a year, likeliness is that the circumstances of that rental property are pretty dire, and that pushing down of the price may impact individuals on the 95% LT fees. Now, it'll only impact them once it comes to their refinance, which could be 2 years, which if it is, then that's a problem. And if it's in 5 years, less of a concern that would be. However, what tends to prevent people from being able to secure mortgages isn't actually the deposit amount, but rather the amount of income they actually have. Because mortgage lenders will stress test to see if interest rates go up, can this person cover the cost of that? This was a little bit of juicy knowledge that I was made aware of this morning actually by my fellow business partner Joel Pickett. So the government is trying to encourage a lot more people to become home owners through the mortgage guarantee scheme, and yet the main barrier for people becoming homeowners is actually their income level and mortgage lenders' criteria. So it has very little to actually do with the deposit amount. Also, what makes that problem worse is that due to having a 5% deposit, you're most likely, if not undoubtedly, will be paying a premium for that, which will make it less affordable if you don't have a high income. Meaning, due to the premium you're paying because you can't afford to actually be buying this property in the first place because you don't have a big enough deposit, the interest rate and with the capital repayment is going to be much higher, and that means you have to have a much higher income to cover that, and most of these people that would really benefit from this kind of scheme are not going to be able to meet that criteria. So the government's aim is to bring people into the market as homeowners, giving them that confidence in their home, then the issue is not about the LT fee. It's a underlying issue that people simply cannot afford the property. Like I said earlier, you're fudging the numbers to make it so that people can afford that property, but in reality they're paying higher interest rate and they're just loaned more capital, that's all. So if the issue is that people can't afford property, how do we go about resolving that? Well, I'm a big preacher of employment opportunity to resolve most problems. By enriching employment opportunity, you're able to give people a greater variety of jobs that will better fit their personal character, and they'll be a good match for those particular roles. And also through improving the quality of these jobs, you're able to provide a higher amount of income. However, as I was doing my research, I found that most people, in my personal experience as well, regardless of how little they can earn, can always find a way to save something. Now, some circumstances are excluded from that. Sometimes people have a family quite early on, and that might make it quite difficult to save due to the sort of timeline of how you've developed your life. And I would say the best way isn't actually employment opportunity, but rather it's about improving financial education. So I found that by the end of 2020, only 3% of UK Brits actually use stock and shares ISA. Incredibly small amount is uptaking investment options and are instead relying on banks. And we all know, well, in fact, it wasn't particularly common knowledge to me. It struck me as quite a surprise when I found out that obviously inflation tends to be much higher than what your interest is in the bank. So with each year, your money is worth less. So we need to really focus on financial education and teaching individuals how to leverage the many different options there are available to achieve a better interest rate or return on investment. And through doing that, you mitigate the need to rely so much on employment opportunity, and instead it becomes a cultural problem that's focused on education, which I'm sure you're not surprised by, that most of these problems come back onto culture and our education. So by educating individuals on the many options available to them to better use that small amount of money that they can save in a slightly better way, they're able to speed up the progress towards having a substantial sized deposit so that they can get a lower interest rate and over the long term be in a much more financially stable position. And I would say once financial education becomes more at the forefront and individuals are better educated around that the focus then moves to financial opportunity and providing more schemes and options that are investment focused with various degrees of risk. For example, government bonds are sort of marketed as virtually risk-free. So there is quite a variety, there's ones for your more conservatives, there's ones for your risk takers out there, and there's ones for you who are really risk averse and would rather have something similar to the security and stability of a savings account with a bank. It's through tackling those deep-rooted societal issues that we're able to bring a net positive gain to our country. And I simply just do not see this being spoken about at all. It doesn't seem to be a priority. It's all about how can we get people into homes that they can't afford and tie them under bigger and greater financial obligations, which restricts their quality of life and their ability to actually get up and start running. That's John Griffiths of Verus Property Investments. Thank you for listening to this rant. I hope there's some sort of knowledge there. If anything, if you do disagree with me, please feel free to have a full-blown argument with me. I'm very good at managing my stress, but honestly, I want people to disagree with me because I feel like this is quite a pessimistic view that I have, and I would very much welcome a more positive mentality, but at the moment I simply do not see that. Thank you. John Griffiths of Verus Property Investments. Have a lovely day.